Are premium bonds actually worth the gamble? It's a good feeling when you win for sure, but when you do the maths on it, are you actually losing out? Would you be better off just saving as normal cash with interest rates as they are right now? Let's figure it out. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. In this video, we'll talk about two common ways to hold cash, high interest rate savings or premium bonds, but which is better? But first, let's define what each of them are and make sure we're on the same page. High interest on cash. Really, this applies to any high yield savings account, but because it pays a pretty competitive rate of 5.2% on uninvested GBP or pounds in cash, and a lot of you viewers are using Trading 212 anyway, we'll just describe this as Trading 212 5.2% on cash just to keep it simple. On Trading 212, there are no balance limits, allowing you to earn interest on your entire uninvested cash balance, regardless of its size, with a single rate applicable to all. Additionally, there are no withdrawal restrictions, so your cash is always available for use. You can withdraw or invest at any time without affecting your interest rates or incurring any penalty fees. Moreover, your interest is paid daily, maximizing your earnings. Let's say you put some cash into your Trading 212 account and opt into their 5.2% interest deal. You'll earn some money each day. It's like getting a nice little reward for keeping your cash in the account. If the daily reward is less than 1 pence, it adds up until it reaches that amount before it shows up in your account. This happens every day, so the longer your money stays in the account, the more you'll earn over time. Just remember, the interest rate can change depending on what's happening with the Bank of England rates, so keep an eye out for any updates. On the topic of Trading 212, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section. Capital at risk. If you've opened up a new account recently or planning to open an account, here it is. DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. Okay, now let's compare with premium bonds. Premium bonds are kind of similar to a savings account, but with a unique twist. Instead of earning interest, you get a chance to win prizes each month. It's like a monthly savings lottery, but you keep your money spent on the ticket and can reuse it each month. For me personally, it's the only lottery type thing that I would play, as there's still the thrill of chance of winning, but without the downside of losing the money you spend on tickets. The odds of winning in the monthly prize draw are 21,000 to 1 for every £1 bond, though this is variable. The annual prize fund rate is also variable, currently at 4.4%. Both of these could be different when you're watching this video in the future, so it's best to double check on the NS&I website. Importantly, all prizes are tax-free, so you won't have to pay any taxes on your winnings. The minimum amount required to participate is £25, while the maximum you can invest is £50,000. This is a great option for you if you fancy winning tax-free prizes of up to £1 million, have £25 or more to save, and want to make the most of tax-free saving, or wish to buy a savings gift for children under 16. However, it might not be suitable if you want regular income, looking for guaranteed returns, or concerned about inflation, or want to save jointly with someone else. So, which is best? Let's look at the pros and cons of each. Pros and cons of the Trading 212 5.2% interest on cash. The pros. High interest rate. At 5.2%, the interest rate is quite competitive compared to many traditional savings accounts. This can significantly boost your returns on idle cash. You can definitely get higher than this, but usually requires some loopholes to jump through, like depositing regularly or up to a certain amount per month. So 5.2% with minimal restrictions on the how and the when of deposits, etc., is realistically pretty good. Daily interest accrual. Interest is calculated then added to your account daily, which means your money benefits from daily compounding. This can help your savings grow more quickly over time, as the compounding process is slightly quicker. Like the almost daily dividends portfolio, it's also a good dopamine boost, if I'm being honest, to get a notification each day. No minimum balance. There is no minimum balance required to earn interest. Whether you have a small amount of cash or a large sum, you'll still benefit from the interest rate. The only thing is that they'll only pay out interest once you've reached the threshold of 1 pence. Until then, it will accumulate and essentially be waiting until you hit the 1 pence payment. Easy access to funds. The cash remains relatively accessible, so you can withdraw it whenever you need without facing any penalties or major delays. This is in contrast to fixed term deposits that can offer higher amounts but require you to keep the money in the account for 1 or 2 years at a time. Tax-free in an ISA. If the interest is earned within the individual savings account or ISA, it's tax-free. This can provide you significant tax advantage compared to regular savings accounts, though this will eat into your ISA allowance. The cons. Risk of capital loss. The money is invested in qualifying money market funds or QMMFs, which, while generally really low risk, are not risk-free. There is a very small chance that the value of these funds could decrease, potentially leading to a loss of some of your cash. While Trading 212 itself is regulated by the Financial Conduct Authority or FCA, the cash in the QMMFs is not protected by the FSCS or Financial Services Compensation Scheme if the funds lose value. Many savers look for this safeguard when depositing money, so in order to get the FSCS protection, I believe you need to hold within the cash ISA. Variable interest rate. The 5.2% interest rate is variable, meaning it can change in response to economic factors such as changes in the Bank of England's base rate. This could result in lower returns if the rate decreases in the future, and the rate can change quite quickly, so it's important not to be caught off guard. Taxable outside of an ISA. If the interest is earned outside of an ISA, it will be subject to tax and will count towards your personal savings allowance. This can reduce the net benefit of the high interest rate. One extra point I need to make here is that to earn the interest, you need to actively opt in through the Trading 212 app. This additional step might be inconvenient for some users who don't pay full attention and then just assume that it's applied automatically, where it's not. Pros and cons of premium bonds. Here are the pros and cons of premium bonds offered by National Savings and Investments, NS&I. Pros. Chance to win tax-free prizes. Each month, bondholders have a chance to win tax-free prizes ranging from £25 to £1 million. This can be very exciting and offers the potential for significant returns. If you like the dopamine hit of getting interest every day, checking the prize draw at the start of each month is a way more powerful hit. No risk to capital. The money you invest in premium bonds is safe. Unlike other investments, your initial capital is secure as it's backed by a UK government. Tax-free returns. Any winnings from premium bonds are tax-free, which can be advantageous compared to interest earned on regular savings account, which may become subject to income tax. Flexible access. You can cash in your bonds at any time without penalty. The downside is they won't be entered into the next draw. This offers flexibility if you need access to your money quickly. One thing to bear in mind though is it will take a couple of days to get the money from the NS&I account to your bank. Now here are the cons. No guaranteed returns. Unlike traditional savings accounts, premium bonds don't pay regular interest. There's no guarantee that you'll win any prizes, which means your money might not grow over time. This is especially the case when you have a smaller amount deposited, as you can go months without winning anything. Money Saving Expert has a great quote on this. Line up everyone with £1,000 worth of premium bonds in order of their year's winnings, and the person halfway along would have won not a penny. In fact, you need to walk past 60% of the line until you hit your first £25 winner. Inflation risk. With no guaranteed returns, the real value of your money may decrease over time due to inflation. This means that while your initial investment is safe, its purchasing power, or in other words, what that money can actually buy, could decline. Lower expected returns. On average, the returns from premium bonds are often lower than those from savings and investment products, especially if you're not lucky with the prize draws. Minimum investment period. Premium bonds must be held for a full calendar month before they become eligible for the prize draw. This means you won't have a chance to win immediately after purchasing the bonds. If you're moving in and out of your holding, then it's very likely that you won't be winning anything near enough to be worth it. So, which is better? It's not really a case of one being objectively better than the other here. It's more like each of these have a different use case that may be more or maybe less appropriate for you. Here are some of my thoughts of when to use either of these vehicles for saving money. Trading 212, 5.2% interest on cash. Best for short-term savings, liquidity needs, tax-free interest, but that's only within ISAs, and those without large amounts to invest. Not ideal for long-term growth seekers and have to be wary of earning interest outside an ISA. Premium bonds. Best for capital preservation, tax-free prize potential, so it does have the fun factor, flexibility without penalties, and to a degree, portfolio diversification. Premium bonds are not really ideal for those needing guaranteed monthly income, as it's reasonably likely you might not make anything in a given month, or inflation protection, or those with smaller amounts to invest who want regular returns. And there we have it. Which one will you go for? If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you.
I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!